All right, we have Aaron Gibbs back with us, Dan Geltrude, Rebecca Walzer on this money, because how it is spent, if it's spent at all, is going to be very important, I guess, for the economy. Aaron, if people just save it, of course, they can do whatever they want with it. It's their money. But the argument is always that if they do that, it won't have much bang for the buck. Do you agree with that, and what do you see happening?
Right. So if we looked at the last stimulus check and the hurdles to get the checks were even lower, you could make more money. About 1/3 went to spending immediately, 1/3 went to savings, and 1/3 went to paying down your debt. Now, we know with higher gas prices, higher interest rates, we might see a little more going to spending and paying down your debt, especially if your credit card interest rates are going higher, and a little less on savings. And so I think that would be expected given where we are this year versus last time, and that we're going to see a much lower savings rate.
Yeah, I'm wondering too, and as things get more volatile, that gap we were showing it before with a chart, and I always like to bore people if I can. I've built a career on it. So I look at two very different rates that are now crossing each other. That is the yield on the 10-year note and the yield on the S&P 500. And it used to be a chasm between the two, essentially meaning that it was foolish of you to think of investing in fixed income because you got almost nothing for it. And stocks were the only place to go. Now there's some competition, at least if you want an alternative. Is it, and if this remains the case, should stock investors be worried? And should new investors prone to look at stocks be rethinking that?
So we're still a ways away. We quite haven't hit that tipping point, but it is something that you should be monitoring, because once you hit that risk-reward ratio where bonds suddenly look a lot more attractive, you will see and the institutional money managers moving cash from equities into bonds. And that can have a big impact on overall in equities. But I think the bigger impact here is that we're really looking at a cyclical economy. This is all about economic growth that's therefore driving the market. And we're seeing new types of sectors being leadership, like financials, energy, materials. So I think with all this stimulus, we're still pretty safe for now that the stock market is going to do well in, let's say, the next 12 months. Inflation is something that's a little farther out there that you should be worried about, but not just yet.